All right, let's start out with your word of the day. What is your word of the day, and what is it? What are you looking at?
Well, we've been calling this an owl market for a while now. It's where investors look 360 degrees left, right, and center all over the place looking for confirmation of the bullish move that we've seen really since the lows of April. And that's everything from the economic data all the way to market internals. And every time there's a negative headline, that owl comes out, looks around to see whether or not there's confirmation on the negative side, too. And once it doesn't happen, that wedge is removed from the market, and we start to trade up.
All right. The president announcing a lot of tariff proposals, chips, copper, also pharmaceuticals, even though pharmaceuticals would be down the line. Does that change your math when it comes to the market and specifically the Fed potentially cutting later this year?
The only thing that would change the math for us and the calculus overall is to our view is what happens with the profit cycle. And we actually see profit revisions going up in the context of everything that's already been released or potentially going to be implemented. So profit cycle is stalled out just a little bit right now, but still positive. But we expect profit revisions to continue. And we've already started to see that. And the U.S. is actually leading on the profit revision side. And we still haven't talked about 2026, which most investors will be beginning to discount by the fall. So with the Fed is squarely in holding mode right now. It's clear on that. They've talked about that. But we expect a little bit more dovish speak coming because of some soft patch signs that the economy may actually induce here up ahead of September and October's jobs reports.
So if you're expecting a little bit of dovishness, how does that shape your view when we're talking about the cyclicals? Industrial is the leading sector. We've seen a strong bounce after April from the financials, and also small caps have been on a multiple-week win streak. Do you like those sectors? Do you feel like maybe that those trades might be overdone?
We think the word, in addition to owl, over the course of the next few years is going to be diversification. I know that's an overused, discussed term, but rarely implemented, and that goes as far as international relative to the U.S. as well. We think a diversified portfolio across size, geography, and style makes sense, but also rotation within the market. You mentioned cyclicals. We do think that some of the beaten down cyclicals make sense, but cyclical growth, whether it's financials, industrials, and even the tech space, is still our areas that we believe lead the market. Overall, some of the areas that consumer discretionary have taken some pressure on them recently because of concerns over consumer spending. We think that that's just a stalled out period. We think that gets going again. But overall, on the small cap side, it has been a real tough go. We've been offsides on that a little bit. We raised that a couple of years ago to a slight overweight about a year plus ago. It's a very tiny overweight for us, but we expect that valuation gap that's been there for quite some time to narrow itself. But we still believe high quality, large cap rotation within the market is just getting going.
All right, well, we're talking about the cyclicals. Let's go back to the financials for a second. We've been talking about this earlier, softer dollar, the long bond at pretty much a 15-year high. How does that shape your view when it comes to cyclicals? When you said right now the Fed is on pause, you see it as being more dovish, but we really don't know. And we also just don't know what's going to come from the administration when it comes to tariffs. And Jay Powell was very clear. Tariffs have been the delay, the reason for the delay in rate cuts.
Firm on this. We believe tariffs overall is just a tax on growth. So eventually, even if there's knee-jerk price hikes that do pass on to the consumer, which have yet to emerge, if they do, it's a one-time event, at least in our opinion, and ultimately that'll begin to fade. Plus, some of the supply coming on stream in housing is causing some pressure a little bit on prices in certain parts of the United States. That'll filter over into a little bit of a downward move in CPI as well, which is about 2/3 based on housing. So all of this is just in a holding pattern. And the window is likely to open for the Fed next year. This year, be more about wait and see. They've told us that. They're looking squarely at the jobs market. And overall, from a cyclical perspective, we do believe that those profit revisions we've all been waiting for on the cyclical side of the equation begin to pick up starting next year, particularly as this bill starts to fill through. Retroactive CapEx starts to hit in the third quarter, new CapEx in the fourth and first quarter, and then individual beneficiaries as it relates to individual tax cut extensions begin to happen next year.
You know, speaking of profit, I want to talk to you about profit for a bit. Of course, we're about to go into earnings season. One of the areas you like are large tech companies. So WPP, they did a profit warning earlier today, talking about some weakness in ad spending. Now, when we're talking about some of these big tech companies, whether it's Amazon, Microsoft, et cetera, Meta, of course, ads are becoming an incremental part of their story and part of their growth story. Is that possibly a concern for earnings season, that we're seeing weakness in ads that could spill over to these mega cap tech companies?
We don't see that as a widespread basis. That is more of a small vertical than it is horizontal. Some of the ad spend that's been pulled back recently across the board has a lot to do with where companies are actually placing their CapEx, their actual overall expense budgets. They're really plowing a lot into capital expenditures. That's been going on for a little bit, but it's accelerating right now. We expect that to pick up in 26. So as they look at their overall expense base, a lot more of that will be exposed over to capital investment. We think, Frank, we're on the verge of one of the greatest CapEx booms we've ever had, at least in the last 5 or 6 decades, and everything infrastructure around that, robotics, automation, generative artificial intelligence, data center buildouts, all of that is starting to begin to accelerate. We heard announcements before, but it's now actually starting to be applied.